Yeah, good afternoon, everyone. It's an absolute pleasure to be with you today. As was just mentioned, so I'm part of the European equities team. I'm the head of the European equities team at BlackRock, and also lead portfolio manager for this trust, the BlackRock Greater European Investment Trust. And we're going to use our time with you today to provide a general update on this trust, to remind everyone of the investment philosophy, but also to talk a bit about some of the compelling opportunities we can find within the European market at the moment. And as was just mentioned, we'll leave plenty of time for questions at the end. If you could please go to the fourth slide, please. Yeah, so I guess to start with, let me remind you of the investment objective of this trust, which is to deliver long-term growth in capital for our shareholders. To achieve this, we look at our addressable universe of over 2,000 listed companies in Europe, and we bring this down to the 35 to 45 most compelling investment opportunities that Europe has to offer. That means we build a relatively concentrated, high conviction portfolio that invests in some of the best businesses listed in our region. And currently we have about 34 holdings in the fund. Now, our job is to carefully construct this portfolio of what we think of as wealth creators, companies that often dominate their respective markets, where we see that persisting as well, for a long time to come. And ultimately, our approach to running this trust is that, once we have identified what we think of as a winning franchise in Europe, we like to size our positions large, and we, typically run those positions to let the value creation happen over time. Because when we think about wealth creation more generally, we think it's a relatively simple recipe for wealth creation. We're looking for three key ingredients. We're looking for businesses that have high returns, growth, and time. And that last element, giving a management team the time to execute on their strategy is what often gets a little bit forgotten by investors, we find. So in this trust, we aim for to be long-term owners in businesses, and we aim for average holding periods of 3 to 5 years. And many of our holdings have actually been here in the portfolio for much longer than that. You could go to the next slide. Just a few words on the team. So as a team, we just run about 23 billion pounds of assets across 12 different strategies. This makes us one of the best resourced European teams in the market, with 22 investment professionals, and we're covering the market by sectors. And there's a huge amount of experience within this team. Many of our analysts have covered their respective sectors for a very long time. We've built a huge wealth of knowledge in important parts of the market. And what makes our team slightly different from other teams is that we lead in a number of different categories in the market. So we have the largest XUK franchise in Europe. We've got one of the largest income strategies, a large value strategy as well, and we also do long short. And what that means is that when we come together as a group, we can challenge each other in a very constructive way. Different people coming to an investment case with different insights and different perspectives. And for us, that's really important, because when you want to make good decisions on the portfolio, you're basically looking for those different insights and the diversity of thought, building a complete picture as possible. It also means that over the years, we've added additional capabilities. We've got a dedicated data scientist working for the team. We've got a forensic accountant working for the team. And ultimately, this is all done to build more knowledge on companies than anyone else on the street. And ultimately, we want to be in a position to identify businesses where we think the earnings power of the business hasn't been fully captured by the market, by consensus forecasts. And as a business, delivers on what we, over-delivers really on earnings and cash flows, you get that positive share price performance over time. And that's what the team is set up to do, and that's how everyone is incentivized on the team. We go to the next slide, please. Talking a bit about the criteria we apply in this strategy when it comes to stock picking. As mentioned earlier, Europe is home to over 2,000 listed companies, and quite a lot of those businesses actually are global leaders in the industries they operate in. This is also why we often make the point is that you don't necessarily have to be positive on the European economy or on Europe as a region to be a shareholder in this trust. Many of the businesses that we own should do well pretty much regardless of what happens to the European economy. And that's because when we pick those stocks, we apply some very strict investment criteria, as our companies are typically run by exceptional management teams with clearly defined strategy for value creation. It's companies earning a high return on the capital they invest, and they generate significant amounts of cash, which provides them with the optionality to deploy capital at high returns in growth projects, which is ultimately how value is being created over time. And actually, when we think back and step back for a moment and think back over those last 12 to 24 months and the environment companies had to operate in, we can, obviously, we all know we had a period of high inflation, supply chain disruptions, and a multitude of other cost pressures. And therefore, we could probably argue that this has been the ultimate test for any management team that we own in this trust. And this is why we pay so much attention to those management qualities and invest in businesses that have pricing power, that have scale in procurement, and where we see strong track record in managing those supply chains and in execution more generally. Now, when we think about wealth creation, more generally, we also aim to carefully select businesses that align this trust to end markets and income streams that have the potential to create value on a duration basis. That often leads us to own many of the enablers and businesses that are right in the middle of some of the transformational changes that are going on around us in areas like reshoring of supply chains, the energy transition, decarbonization of transport and the economy, as well as advances in life sciences and digitalization of the world around us. So thankfully, Europe has a lot to offer when it comes to those enablers, and the opportunity set remains extremely rich from our perspective. If we could go to the next slide. Now, we put this slide in just to talk a bit about how the macro environment can influence our thinking. And the first thing to highlight here really is that we are bottom-up stock pickers. This means that while we take account of the macro environment we operate in, all of our views are ultimately built from the bottom up. As a team, and I've showed you this team just now, we do over 2,000 company meetings per year. And it's those interactions with management teams across the market that tells us what's going on in the world. And this is really important because each year there is a macro narrative in the market that is asking you to change the composition of your fund. Investor conviction levels get tested all the time. And we have decided a long time ago that we are not going to buy into those macro narratives. All decisions we're taking on the portfolio are really based on what is happening to earnings and cash flows of the businesses that we own. And we often like to remind our investors that ultimately we don't own units of economic growth in the European economy. We own units of earnings and cash flows in businesses, and we aim to own these cash flows for a really long time. And I think in this context, also important to point out that ultimately you just need to remember why you own an asset in the first place. When a stock goes against you, to ask the question, how much of my original thesis has really changed? And of course, sometimes an investment thesis changed, and in those moments, you have to be intellectually honest and pragmatic, and you move on. But a lot of the time, we find it absolutely pays to take a long-term approach, to be a long-term thinker, and give a management team that time to execute on the strategy that they've laid out to you. You could go to the next slide, please. And yes, so coming on to positioning a little bit here, we're providing a brief overview of our areas of conviction and some of the businesses that we own in the fund right now. As mentioned at the start, this is a relatively concentrated portfolio, high conviction of what we see as the most compelling investment opportunities that Europe has on offer. That also means that our top 10 positions typically account for about 45 to 55% of the fund. Now, we absolutely want to make sure that when we look at the portfolio overall, that we source the earnings and cash flows at the aggregate portfolio level in multiple different ways, and that those top 10 holdings consist of different companies operating in different industries. And with that, we aim to source returns from many different parts of the market. And that's exactly what a large and well-resourced team allows us to do for our clients. Now, conceptually, we like to own businesses that have a product offering that's so unique that it affords them a great deal of pricing power. In Europe, we can find that in a company like MS. We also like businesses who operate in duopolistic or oligopolistic market structures, where demand is so strong that visibility on growth in earnings and cash flows extends over very long periods of time. And for us, Novo Nordisk clearly falls into that category. And lastly, we also like to own businesses that are very innovative, where a new technology has the potential to completely transform how things are being done in a given industry. And for us, our holding in a Dutch semiconductor equipment company, BE Semi, with its hybrid bonding technology, clearly falls into that camp. And we'll spend a little bit of time just now to go into a bit more detail on some of those names. So if you could go to the next slide, please. So let's start then by looking at BE Semiconductor in a bit more detail. Our investment in this company, it was actually the top performing stock in the fund over the last year. It's up about 120%. This company designs and produces mission critical semiconductor assembly tools, which are used by chip manufacturers, assembly subcontractors, and electronics and industrial companies. It is run by one of the best management teams that we know. And over the years, this team has done a fantastic job at managing the business through cycles. And the evidence of that we can see in the bottom left, where you can see how margins have stepped up cycle by cycle, having become one of the most profitable company in the process in that semiconductor industry globally. So what exactly do they do? They're a leading provider of packaging solutions, such as hybrid bonding, which is set to become increasingly important technology in enabling semiconductor chips to continue getting smaller, more powerful, and more energy efficient. Earlier in the year, there was a lot of excitement in the market when a large US-based chip designer said that they were seeing surging demand for data center products used in generative artificial intelligence, such as ChatGPT. Now, this is just one of the many use cases BESI's tools are used for, but it's clear to us that to meet the demands of the emerging artificial intelligence technologies, semiconductor chips will have to become more powerful, meaning that chip manufacturers will need to really increase their use of products such as the hybrid bonding technology produced by BESI. And when we look at the chart on the right, you can see investment spend estimates for the industry overall to 2030, which are showing very significant growth for a long time to come, which BESI is able to tap into. which is why we remain so excited about this investment case going forward, as we can see a long run rate in wealth creation ahead for the company. And to the next slide, please. Slightly different, but also very exciting company is Novo Nordisk, which is the global leader in diabetes care. One of the segments they operate in is called the GLP-1 segment, and that's where they really operate in a duopoly with Eli Lilly. Now, in that segment, they produce a molecule called semaglutide, which has already been hugely successful, which has been sold under brand names like Ozempic and also Rybelsus. And that franchise, which makes up about 50% of group sales, is growing at 50% and is generating a 90% gross margin, which, when you think about for a moment, are incredibly powerful levers for value creation. To make things better, the prospects of the company have again improved quite significantly over the last year, because the company brought a new obesity drug to the market called Wegovy, and that's really moved the share price quite a lot. Shares are up over 60% over the last year, and we think that it is this obesity market opportunity that is really quite significant. There are estimated to be about 764 million people living globally with obesity, and only a very small percentage of these are currently being helped by healthcare professionals, and even fewer are treated with medicines or medications. And that's because the side effects of the older therapies mean that very few people actually stay on the treatment for more than a year. Now, Wegovy has not only shown strong efficacy when it comes to weight loss, we also think it has an opportunity to really disrupt the market and help people to stay on the drug for really long times to come. The investment case, got another boost, fairly recently, as Novo reported a clinical outcome trial that showed that the drug also lowers major adverse cardiovascular events by over 20% for patients that are on the drug, opening up a whole new market opportunity for the company. So overall, we think these results will underpin the validity of this new category of obesity drugs, but they also underwrite the future growth of the business in a very significant way. That growth is coming at very high returns. And what we like when we look at the investment case more generally is that consensus expectations, as often is the case, are getting maybe year one growth estimates right, but are then fading the growth quite aggressively in the outer years, which we don't think is likely to happen, given that the company had been operating at capacity, completely sold out in 2023, and we see 4 new production lines coming on stream in 2024, which should really propel growth going forward. The next slide, please. And then the last stock example is MS, which is probably, it's operating within the luxury goods sector, but it's probably one of the most unique businesses that we own. In our mind, this stock absolutely belongs to a select group of companies that we would classify as royalty within European listed equities. It's unrivaled when it comes to the provenance and heritage of its brand. I think it's close to 200 years old, and has real pricing power when it comes to the product portfolio overall. The most profitable division is called Fashion Leather Goods, and within that you can find products where we have waiting lists of up to 5 years for the most iconic products like the Birkin bag. That's because the company is short of product. They can't keep up with the demand. It takes up to 5 years to train a craftsperson to build the different handbags and leather goods that they offer. So they find themselves in quite a unique situation. They can only produce about 6 to 8% growth in terms of volumes, but demand is clearly much higher. And as a result, what we have learned over the years is that they can basically shift their product to the markets where they see the greatest demand. Where the products are coming into a store, you often find that the store owner is inviting their best clients to buy the most iconic pieces. So sales happens on allocation, and it also means that they can circumvent situations like we saw in 2021 and 2022, where periodically the Chinese market was locked down, and they just shifted the product into other regions where the demand remained very strong. This business is also family owned, so 2/3 of the business is owned by a family, which has run the group in quite a conservative way for a really long time. And that means that any decisions that are taken are really taken with the longest timeframes in mind, which is another thing we really like here. And as a last point, as people are worried about slowdown and recession, this is the last company we worry about a slowdown in sales. It has proven absolutely recession-proof over the years, and grown really nicely, even in periods like the global financial crisis. And we expect that to happen again in the future. To the next slide, please. We so just also wanted to briefly comment on a relatively large overweight we are currently running in European industrials. For us in Europe, this is one of the sectors where we can find many of the companies that are enabling some of the large transformational changes that are going on around us. Again, companies exposed to the energy transition, electrification of our economies, or companies that are seeing huge investment spend on the back of the trend to reshoring of supply chains. And in many instances, as you probably know, those trends are only just beginning and come after a long period of underinvestment from many corporates post the financial crisis. In fact, when we think about what we've heard from some of the businesses we talked to, we spoke to the CEO of a UK-listed construction rental equipment company, and they recently referred to the environment as a modern era industrial revolution with an unprecedented number of mega projects being signed off in the US and Europe at this very moment. In many of these cases, these projects are being backed by government programs like the Inflation Reduction Act in the US or the European CHIPS Act. And the chart on the right shows the significant uptick in manufacturing spend in the US, speaking to this reshoring phenomenon. I think at the half-year stage, CapEx spend was up, close to 60% year over year. And many of the businesses we own in this trust, particularly in the industrial sector, are benefiting from that spend coming through over the next couple of years. The next slide, please. And that's really bringing us already to the end of the presentation. We wanted to also comment briefly on performance. Now, when it comes to performance, we actually believe that we can deliver the best results for investors in our trust over the medium to longer term. You can see here that over 1 year, the trust managed to outperform its benchmark by just over 1%. But if you cast your eyes over those 5-year numbers, you can see our share price outperformed its benchmark by just under 18% over that period. And that's really where our team is firmly focused on producing that growth in capital over the medium to longer term. We think that it's over the medium to longer term that it pays to take an active approach to investing in European equities. And we really see the benefits in adopting that long-term approach where we put owning businesses over trading in shares. And with that, we can pass it back to the moderator, please, and maybe start answering some of the questions that hopefully have come through by now.
Thank you, Stefan. Yes, do please. I'm looking in the question field. There's nothing in there at the moment, so everyone's asleep at the wheel. Please put some questions, type away, and I'm sure Stefan will be delighted to answer your questions. Don't feel shy. Do remember, if you see something that you like, vote for it as well, and I'll put it to the top of the pile if we ever get a pile. Charles has just asked, has the trend for ESG promoted stocks come to an end? And do you agree that the ESG ratings are fundamentally flawed? There's a leading question. But any comments on ESG generally, Stefan?
Yeah, so I guess there was definitely a period, probably back in 2021, where a lot of the ESG related stocks were catapulted to quite high valuations. And in many instances, it wasn't necessarily backed by earnings and cash flows at the time. So there's a lot of future optimism priced in. And I think the question is right. We've seen valuations come down quite significantly. We've also seen big issues in parts of the market that would have been owned by ESG funds like offshore wind, which has gone through one of the most terrible times in the last 12 to 18 months, very badly hit by supply chain issues, cost inflation, contracts not being struck in the right way. So we've seen a number of profit warnings, and so I think there has been a reality check. That's absolutely right. But to be honest, for us, we think that's quite a healthy element. And again, some of the businesses we own, they either directly or indirectly are benefiting from the fact that companies around the world are now thinking about CO2 emissions in their supply chain, of their buildings, whatever it might be. And so we've seen very resilient demand when it comes to some of those end markets. So that's maybe the first part of the question. Second part, I can tell you that, again, I guess we saw a huge move to ESG investing, and a lot of houses were relying on external consultants and providers when it comes to ESG ratings. And again, we have to admit that in some instances, we were in disagreement with some of those consultants and providers because they weren't acknowledging how much change was going on in some of those businesses. And so we used some of the knowledge and analysts we have internally at BlackRock to help them understand that they shouldn't mark down a company that is on a huge transformation and moving in the right direction, and kind of factor in what the end state might be. So yeah, that has been evolving as well over time.
Okay, thank you. On energy stocks, question from Lucy here. Do you consider energy stocks given the higher oil price at the moment? Yeah, so that's an interesting part of the market. And I guess last year was really the year of energy. And what you saw was last year energy was up 25% as a sector after years and years and years of underperformance. And every once in a while, there is a trade in energy stocks. And last year was one of those years. And then we saw them underperform quite significantly in the first half this year with earnings downgrades coming through. In this trust, we look at everything, but the one predominant question whenever we look at new ideas, I sit in front of this board, the board of this trust, 5 times a year, and my dealing and my decisions get scrutinized. And so one of the first questions I always ask is when I look at a new idea, can I own an asset for the next 3, 4, 5 years? And can I tell the board with conviction why I'm owning them, and what the levers are to that value and wealth creation I talked about in the presentation. And the problem I've got with some of the traditional oil companies, if you like, is that the P&L is driven by one variable that nobody really knows how to forecast accurately. And you've got huge volatility over time and huge volatility in returns. And you could argue that the management team isn't really in full control of what's happening to the business. I mean, we could spend the next half an hour talking about oil and gas. I also was an oil and gas analyst on the team for 5 years. But that's why you find less of those companies in the trust. The volatility of the earnings and cash flow profile, the lack of predictability on where things are going. And like for some of these companies, they're also on a major transformation when it comes to the energy transition, trying to become more renewable in their portfolio. And we would question the returns that are on offer in those renewable portfolios in 5 and 10 years' time. So that's why we are underrepresented there. Okay, thank you. Mel would like to know if you've got any comments on the appointment of a co-manager for the investment trust.
Yeah, so so we have those co-manager structures on the majority of team portfolios, and actually the way this works is often it's just a natural progression of how we have been working already for quite some time. And so I was really pleased with that announcement, last week, because I've been working really closely with Alex Dangour for quite a long time now. I think she's hugely talented. She's bringing a lot to this trust, and ultimately, we'll be working in a strong partnership to make sure that we deliver for our shareholders going forward. And I'm really looking forward to that.
Okay. Will that change the dynamic in terms of investment decisions at all?
Not really. I mean, in the first instance, I'm the senior partner on the strategy, but to be honest, what you want is you want someone to come to the table who can challenge your views, who ask the right questions at the right time. And with that, again, coming back to this idea of diversity of thought, different insights, because ultimately it all comes down to getting individual decision rights on individual companies. And, that's exactly what Alex is bringing to the table.
Okay, thank you. And just in terms of the greater Europe markets in general, we're talking the other day about the American markets and the kind of growth versus value debate,
Yeah.
and the fact that at the moment one could argue that the growth companies there are maybe overpriced. The American market, in terms of PE, is looking a bit pricey, but on the other hand, value stocks may still have some momentum in there, relative to the growth stocks. Do you look at the macro picture like that in Europe as well and take that into account? And what is your view in the equivalent questions asked around the European market at the moment?
Yeah, so there are a couple of points there, and I won't talk too much about the US, but one observation would be, if you take the S&P 500 and you take out the 7 largest tech stocks, you would actually find that the rest of the market is trading at multiples in line with pre-QE, I think, almost. So at a reasonable multiple. So it's basically the multiple has been lifted by those top 7 stocks in terms of weight. What we find in Europe, and again, this is an observation because this value versus growth debate was particularly rampant last year. And we heard a lot of people saying, we're in a new regime, inflation is here to stay, interest rates are obviously much higher, we're not going to go back to the low to negative interest rate environment. And actually, we completely agree with that point. But with that, there was also kind of a flippant comment often that said, what has worked the last 10 years is not going to work for the next 10 years. And actually, I thought it was really interesting that if you fast forward into the middle of 2023, the market was led higher by technology stocks. And for us, many of the semiconductor equipment manufacturers, as I was talking about PE Semi earlier, had done really well. And I think the point is here that you can be in a new regime of higher interest rates, and that's all good and well. And what this means is you apply a higher discount rate to valuing share prices, and that's what's largely happened in 2022, and you saw a lot of derating in a lot of companies. But what you can't change is the way the world is changing around you, and some of those transformational changes we were trying to address and point to, they are going to go ahead regardless of whether the interest rate is 1% or 4%. And that's, I guess, what we're seeing right now in our companies. And actually, if anything, we're finding some really interesting opportunities in what could be perceived to be growth stocks, because the valuations have come down a very long way. And we believe that if they deliver on the growth and the returns that we think they're going to deliver, the opportunity set today is much richer than what it was, let's say, 12, 18, 24 months ago. So it's a really interesting time, to look at our market.
Okay. And do you take that into account in your decision-making processes at all, in terms of value versus growth and the balance in the portfolio, or is that kind of irrelevant? You're just looking at individual companies?
Well, to be honest, so we come at it from the bottom up, and we look for businesses that meet the investment criteria. And I can point you to stocks in portfolio that would fall into the value category, but they're not there because I thought, oh, I need to own a value stock. They're there for underlying stock-specific reasons.
Yeah.
And we bought 1 or 2 banks earlier in the year in this trust, and those are extremely cheap. And there's a big debate on banks in the market as well. And again, we could spend a long time on this right now, but we think we can actually own some of those for a really long time to come, because the environment has changed. And equally, some of the businesses that we feel really excited about that would fall into the growth category, we think have now become really very cheap. In some instances, people are worried about recession, consumer slowdown, and we just think that if you take a slightly longer term view, these businesses will come through really strongly, and expectations in many cases have come back quite a lot now. So that's where you can find interesting opportunities across different types of investment and different styles of investment. The last comment I would make is that, because I also do long short in a different capacity, you need to be careful with kind of buying value just for value's sake, because there are companies in the European market that are value for a reason. Yeah, just because a business trades at 6 or 7 times PE, it doesn't make it a good investment opportunity. Typically, the market has worked out that there's a structural challenge to that business, which kind of is questioning the future of earnings and cash flows, the future composition of their profit pool, new competitors coming in, and that's why it's trading at a cheap valuation. So we need to be careful not to fall into that trap, because in many cases, I think the market actually gets it right when it puts a business on a really low valuation. It's typically because there's something going on that challenges the business in a material way.
Okay, thank you. And I noticed the most recent analysis I could find, you've got a very small percentage of the portfolio invested in German companies, which I found quite surprising given the size of the German economy.
Yeah.
Do you have a sort of any kind of policy around how you weight by countries within the Greater Europe portfolio, or is it entirely, it's just it goes where it goes depending on which companies you choose? You're country neutral in that sense.
Yeah. So again, in the first instance, the country allocation is a reflection of where we find the strongest ideas. And for instance, this trust has for a long time had quite a large exposure to Danish companies and Denmark. But it doesn't really mean that we have large exposure to Danish economy, because I was talking about Novo Nordisk, their most important market is North America and the US. And so it's quite a global business. And that applies to some of the other businesses we own in Denmark. And so for us, it's more about, where do we find the most compelling opportunities, businesses that really meet our criteria. And one of the bits that I didn't talk about when I talked about criteria is we focus a lot, when we think about the management team, we think about the culture they instill within the organization, because we find that the most value creating companies typically are run by really strong management teams that instill a strong value creating culture through the entire organization. And when you dig a little bit deeper into that, you find that it's typically flat organizations, decentralized, where you empower people in your local branches or in your local countries to make the right long-term decisions for the business. And those companies deliver really well over time. And I've had this question on Germany in the past, and actually one of the reasons we're maybe a little bit underrepresented is because it's a little bit harder to find exactly that in Germany. It's we have some exposure to some really nice mid caps in Germany where they hit all of those criteria. But when you look at the larger indices, it's a little bit harder to find businesses that that fulfill those criteria, and where you have that mindset of value creation, strong culture, strong focused on returns, cost, and all the rest. And that would be again the result of the bottom-up stock work we've done over the years.
Interesting. We have a question from Charles here. On the valuation point, would you support a demerger of a company that led to more flexibility and visibility of strategy, even at the cost of scale?
Okay, well, I guess that really depends on the circumstances and I guess that on the business in question. So in some instances that could create value, but in other instances we have seen I guess there's lots of examples where over history spin-offs or demergers not necessarily created significant amounts of value. But it's a little bit of a general answer, because we would really need to go into detail of kind of what industry, what business we're thinking about, and what the circumstances are.
Yeah, it could be quite difficult, I guess. Just going back to the country thing, how much analysis do you do in terms of country risk, the different jurisdictions, and how that might affect the risk profile of organizations? Is that ever in your mind within the Greater Europe portfolio?
Yeah. So what we tend to find is that those considerations are really more relevant when you invest in emerging markets. And when you're an emerging market investor, you do the bottom up, but you also need to have a very strong views on currencies, interest rates, regulation, politics. Whereas in Europe, from time to time, what we find is that political changes or a government change can produce short-term volatility, but very rarely does it really impact the earnings and cash flows of the businesses in that we invested in. And so, Italy is famous for having slightly higher turnover when it comes to governments. And what you find is every once in a while it creates opportunities to buy more of business that you already own in Italy, because you ultimately think it's not really going to change the investment thesis or again the earnings and cash flows of the business. And so that's been our observation over the years, that politics in Europe short term can create volatility, but very rarely does it really impact the earnings and cash flows of the business that we invest in a meaningful way.
Okay, thank you. Just on company size in the portfolio, do you have a minimum company size that you kind of don't go below?
Well, I guess one of the advantages of running a trust is the closed-end structure, and so you can really make use of that and go down the market cap spectrum. I think the smallest market cap right now would be about 700 million euros in one of our holdings. I wouldn't see us go much below that, but that's what we're comfortable with, and then we ultimately invest across the market cap spectrum. But one of the best things about our job, our best aspect, is really to find exceptional franchises early, and then you grow with them over time. And so there's quite a few examples in this trust of companies that we bought 6-7 years ago. They were hardly covered by the investment banks in London, and then over time, by nature of the success they have, they become larger. You grow with them, and that's actually one of the best ways of creating value.
Okay, thank you. Yeah, do you have a mandate that allows you to invest in private equity as well, or is it just the public markets?
We only invest in public markets. I mean, in theory, we could have a small allocation to privates, but we haven't really made use of that, for the time I've been involved in the trust. And there's also no specific plans to change that.
Okay, thank you. Right. I think anybody else who wants to ask a question, please type away. It's your last chance. But if nobody's going to type anything, I think we can draw matters to a close. Okay, I'll just keep that box open to one side. But in the meantime, Stefan, thank you very much for your presentation today. Appreciate it, and for a good sort of overview of the European market as well. And wish you all the best with your investing in the Greater Europe Investment Trust for the forthcoming period. I'll be taking a particular interest because I'm a bit lightweight on Europe at the moment, so I am looking to put a bit more in there in the next few months. So you never know, I might buy some. We'll see. Okay, thank you, Stefan.
Thank you very much. Thank you for your time and your interest. Really appreciate it.
All right, you're welcome. Thank you. Bye for now.